In this video, guys, we're going to look at the bull-call spread. Great for those who are moderately bullish on an underlying. Stay tuned. Hey guys, warm welcome to you. So the bull-call spread is great for those people who have a moderately bullish view on a stock or a commodity, whatever it may be. Now you might be saying, why moderately bullish? Well, the advantage of the bull-call spread is it's cheaper than buying an outright call. Well, that's great, you say. Why don't I just buy a bull-call spread all the time? But the thing that you give up for reducing the cost is that you cap your upside potential. So this, as in markets, guys, as always, it takes with one hand and gives with the other. This is the kind of commercial decision you've got to make as a trader. If you think something is going to go off into the stratosphere, then you're going to buy an outright call because you want that unlimited upside. Go and check out a video I've done on call options where you cap your downside risk. The downside risk is always the total cost of the option, but the upside risk is unlimited because you can go up to $1,000, and if you've bought a $10 call option, whoopee-doo, you've made an awful lot of money. But you might just be moderately bullish. You don't want to pay that full premium. So the advantage of the bull call spread is you're buying one option, you're selling another out of the money. We'll look at an example in a second, and that's helping reduce the cost, but the actual cost of capping that upside for you. So let's look at a real world example. So this would be something you're moderately bullish on. You've got capped upside, and as always, when you're buying an option, you've got capped downside. It's just the cost of the option that goes to zero, expires worthless. It's just what you've paid for it. So what we're doing is we're buying one in the money call and selling one out of the money call. Let's look at an example. So we've got stock trading, XYZ stock trading at 42 bucks, and we think it's going to go to 45 is our kind of thesis area. So what we do is, we don't think it's going to go to 100, we think it's going to go up a little bit and want to be paid for that expression or that thesis. So we go long one $40 call at $3. And we sell one $45 call at $1. So what does that mean? The total cost of the deal is $2. That's because it's costing us $3 to buy that, but we receive $1 credit by selling that out of the money call, and it's cheaper because it's further away from the price, less likely to happen, so it's become a cheaper priced option. So the total cost of the deal is $2, and we call it a debit because it's costing us $2. Right, so let's have a look at what happened at expiry to our P&L. So let's say, for example, the price goes down to 40 bucks, right? We're wrong on the deal, hasn't worked out, it's gone down to $40. What happens? So what's the value of our $40 call? We've got the right to buy something at $40 that's currently $40. There's no value in that at all. It goes down to zero. Unfortunately, we were long that, weren't we? We bought that at $3, so we've lost $3 on that so far. However, don't forget, we've got this 45 call, and how much is that worth? It's worth nothing because we've got the right to buy something at 45 that's trading at 40, has no value. Fortunately, we sold that, so we're getting $1 back for that. So we're just losing the total cost that we paid for the deal, which is $2. And you can see that however low that goes now, let's look at example at $10, it's never going to lose more than what you've paid for that group of options, that spread. You know, at the 40 call, it's going to be worth nothing because you've got the right to buy something at 40 that's currently trading at, $10. $10, yeah, it's going to be worth nothing because it's trading at $10, right? Why would you have anything, why would that have any value? Or the right to buy something at $40 that's 10, useless. Same with 45, that's going to have no value whatsoever. But of course, that doesn't change the dynamic of the spread. You still lose the $3 and make the 1, so net you make 2. Net you lose 2, which is okay. So regardless of where that goes, you've capped your downside. Anywhere past $40, you've capped your downside. An easy way to kind of see this is to say, okay, well, there's my downside and there's my upside. Let's look at an upside example very quickly. So let's look at $45. What happens to the $40 call? It's worth $5, right? Because $5, that's right to buy something at 40, it's trading at 45, great. The $45 call, what's that worth? Well, that's worth nothing because $45, zero. That's good because we sold that, so that's great, right? We make $5 on the call and we make $2 on the call, that's worth $5, it's our 5 minus 3, and we make 1, because 1 minus 0 is 1, a profit is $3 per contract. $3 is not great, but that's per contract we're doing. So that's the point where we're making our maximum profit. And you can see that however high we go, if we went to $50, exactly the same scenario happens. The net is still going to be 5, because regardless of how high we're going, whatever we lose on the call, we make on the, whatever we lose by selling the call, we've made on the lower price call. So we've capped our upside at $3. So if it goes into the absolute stratosphere, we've still capped our upside at $3. And if we look at one sort of halfway in the middle, like 44, it trades at 44, it expires at 44, should I say. The $40 call will have $4 of value. The 45 call will be worthless. And so the net's going to be 4 on that. We paid 2, so we made $2. So you can see that this is a good thing to construct if we're moderately bullish. We think the market's going to chug up steadily to a specific point. We can construct it as wide as we want, so where we want to cap our risk. So however far we take that down, if we take it down to 30, then that's our maximum downside area. We could take that up to 50 or 55 if we wanted. And that means that's the area that anything above that, we make no more money. So that's, again, commercial decision for you to make as a trader. Anyway, bull call spread reduces the total cost of the call option at the kind of cost of capping the upside, but good if you're moderately bullish. Take care, guys. See you in the next one. Bye.